Your NZ super payment is about to change. If you don't know exactly what's happening on the 1st of April, you could end up confused about why your bank balance looks different, or worse, you could miss out on money you're actually entitled to. Every single year, thousands of pensioners get caught out by the same avoidable mistakes. There's one rule buried in the fine print that's been causing genuine panic among people approaching 65, and later in this video, I'm going to show you exactly what the government website actually says, because it is not what you've probably read online. This affects every single person currently receiving NZ Super, plus anyone approaching 65 in the next few years, and the numbers involved might surprise you. I'm David, and you're watching New Zealand Pension Plan, the channel where we break down NZ Super, government support programs, and important updates that could affect your finances, so you can make informed decisions and make sure you're receiving every entitlement you may qualify for. Today, we're covering 7 changes every pensioner should check right now. Some of these are about money landing in your account. Some of these are about rules that could catch you out if you're not paying attention. And one of them, the one everyone's talking about online, is actually being reported incorrectly almost everywhere you look. I'll clear that up properly later in this video, so stay with me. Let's start with change number 1, because this is the one that affects your bank account directly. From the 1st of April 2026, NZ Super rates are increasing. This happens every year through what's called the Annual General Adjustment. Unlike a lot of other benefits, which are adjusted to the Consumer's Price Index, NZ Super and Veterans Pension are adjusted according to average wage growth. That's actually a legal requirement. By law, the after-tax rate for a couple where both partners qualify has to sit somewhere between 66 and 72.5% of the average net wage in New Zealand. This is designed to make sure pensioners aren't left behind as the cost of living and average incomes rise. So here's what the confirmed rates actually look like from the 1st of April 2026 through to the 31st of March 2027 using the standard M tax code. If you're single and living alone, you'll receive $1,110.30 a fortnight after tax. If you're single and sharing accommodation with someone else, you'll receive $1,024.90 a fortnight. If you're in a couple and only one of you qualifies for NZ Super, that person receives $854.08 a fortnight. And if you're in a couple where both of you qualify, you'll each receive $854.08 a fortnight, which comes to a combined $1,708.16 a fortnight between you. Now, if your tax code is S instead of M, because you've got other income coming in, those numbers will be slightly lower. We'll come back to why that matters in a moment, because getting your tax code wrong is one of the most common and most costly mistakes pensioners make, and I don't want you to be one of them. Let me put that into a real example, because numbers on their own don't always land. Say you're a single pensioner living alone, and last year you were receiving $1,076.84 a fortnight. From the 1st of April, once the full increase is in place, you'll be receiving $1,110.30 a fortnight instead. That's an extra $33.46 a fortnight, or roughly $870 across the full year. It's not a life-changing jump, but it's real money, and if you don't know the correct figure, you won't know if something's gone wrong with your payment. For a couple where both of you qualify, that combined fortnightly figure of $1,708.16 works out to just over $44,400 a year between you before any other income or supplements are factored in. Knowing your correct number matters because it's the only way you'll actually notice if a payment looks short. Take a moment to consider whether this applies to your situation. If you're not sure which category you fall into, or whether your payments have actually updated, it's worth checking your next statement carefully. Now, here's something most people don't realize, and it's change number 2. The increase doesn't actually appear evenly. The 1st of April falls partway through a normal payment cycle, so your payment on the 7th of April will only reflect a partial increase. It's not until your payment on the 21st of April that you'll see the full new rate landing in your account. If you look at your 7th of April payment and think something's wrong because the increase seems smaller than expected, it's not a mistake. That's simply how the timing works because NZ Super is paid fortnightly, and the 1st of April sits in the middle of a pay period. And while we're talking about payment dates, here's something worth writing down or setting a reminder for. Because of Easter Monday, your normal Tuesday payment in April actually arrives early on Friday the 3rd of April rather than the usual Tuesday. Then your next payment falls on Tuesday the 21st of April. If you're budgeting carefully around when your payment lands, especially around Easter, this is exactly the kind of detail that trips people up every single year. Mark it down now because I guarantee you come the end of March, you'll be glad you did. Let's move to change number 3, and this is genuinely one of the most important things I need to tell you today. There's an enormous amount of misinformation circulating right now about the residency requirements for NZ Super, and I want to walk you through exactly what the government's own website says, not what a random article or social media post claims. You may have seen headlines suggesting that from July 2026, everyone applying for NZ Super will suddenly need 15 or even 20 years of residency in New Zealand. That is not accurate. It's misleading, and if you've been worried about it, I want to put your mind at ease right now. Here's what's actually confirmed by Work and Income and the Ministry of Social Development. Back in 2024, the government introduced a gradual sliding scale for how many years you need to have lived in New Zealand since you turned 20 in order to qualify for NZ Super. This change only affects people turning 65 from the 1st of July 2024 onwards. If you were already receiving NZ Super before that date, none of this affects you at all. The number of years required depends entirely on your date of birth, and it increases gradually, not suddenly. If you were born on or before the 30th of June 1959, you still only need 10 years. If you were born between the 1st of July 1959 and the 30th of June 1961, you need 11 years. It goes up by roughly 1 year for every 2-year band after that. Someone born between July 1965 and June 1967 needs 14 years. Someone born between July 1971 and June 1973 needs 17 years. The full 20-year requirement only applies to people born on or after the 1st of July 1977, which means those people won't even be turning 65 until the 2040s. So if you're in your 60s or approaching retirement in the next handful of years, this dramatic jump to 20 years that you might have read about simply doesn't apply to you. It's a slow, staged increase spread out over decades, not an overnight rule change happening in the middle of 2026. There is one detail that genuinely matters here, though, so listen carefully. Alongside whichever number of years applies to you, you also need at least 5 of those years to have been lived in New Zealand after you turned 50. These years don't need to be consecutive, so if you've spent time overseas and come back, that's not automatically a problem. But it is worth working out your own timeline carefully, especially if you've lived overseas for extended periods. If part of that overseas time was in a country that has a social security agreement with New Zealand, or in the Cook Islands, Niue or Tokelau, that time may count towards your residency requirement. In just a moment, I'll explain the eligibility rule around overseas pensions that catches almost as many people by surprise. But first, let's talk about your tax code because this is change number 4. And it's one of the most overlooked ways pensioners accidentally lose money. NZ Super is not means tested. That means your income and your assets do not affect whether you qualify or how much you're entitled to. You can work part-time, receive rental income, draw down Kiwi Saver, and none of that changes your eligibility. But here's the catch. That other income can absolutely change your tax code, and your tax code directly affects how much actually lands in your bank account after tax. If NZ Super is your only source of income, you'll typically be on the M tax code, and that's what the rates I mentioned earlier are based on. But if you've got other income on top of your pension, whether that's part-time work, a rental property, or investment income, you may need to be on the S tax code, or potentially SH, ST, or SA, depending on your total income across the year. Here's why this matters financially. If you're using the wrong tax code, one of two things happens. Either you're being taxed too little throughout the year, which means you could end up with an unexpected tax bill from Inland Revenue after the end of the tax year. Or you're being taxed too much, which means you're getting less in your pocket each fortnight than you actually need to be. Neither of those situations is good, and both are completely avoidable if you simply check. Here's a practical example of how this plays out. Imagine you're on the M tax code, receiving $1,110.30 a fortnight as a single person living alone. but you've also started drawing a small amount of rental income from a spare property. Because that rental income pushes your total earnings for the year higher, you should actually be on the S tax code, which would see your NZ Super drop slightly to $1,068.30 a fortnight, with the difference collected as tax throughout the year instead of in one lump sum later. If you stay on the M code by mistake, you'll receive the higher fortnightly amount all year, but inland revenue will eventually catch up with the shortfall, and you could be facing a bill of several $100s, sometimes more, once your return is assessed. Getting the tax code right from the start avoids that surprise altogether. Make sure you're not missing out on support you may be entitled to by getting this checked. If you've had any change in your income over the last year, a new part-time job, rental income starting up, or a Kiwi Saver withdrawal, it's worth confirming your tax code is correct, either with work and income directly or with inland revenue. Now let's move to change number 5, and this one connects to money you might not even realize you could be missing out on. The accommodation supplement entry thresholds have also been updated for the new financial year. If you're an NZ Super or Veterans Pension recipient without dependent children, the minimum amount you have to be paying each week for accommodation costs, before you can even be considered for this supplement, now sits at $139 a week for rent or board if you're single and living alone, or $167 a week if you have a mortgage. If you're single and sharing accommodation, those figures are $128 for rent or board and $154 for a mortgage. For couples where both of you qualify for NZ Super, the threshold is $214 a week for rent or board and $256 a week for a mortgage. Here's why this matters. A lot of pensioners assume accommodation supplement is only for people on a main benefit, but that's not correct. If your housing costs are above these thresholds and your income and assets fall within the relevant limits, you could be entitled to extra support on top of your regular NZ Super payment. If you've never checked and your rent, board, or mortgage costs have increased over the last year or two, this is worth looking into. It could mean genuine extra money each week that you're currently not receiving. Think about it this way. If you're single, living alone, and renting, and your rent has crept up over the past couple of years the way rents have for so many people, you might now be well above that $139 a week entry threshold without ever having thought to check whether you qualify for extra help. Some pensioners in this situation are eligible for tens of dollars extra a week once their full income and asset position is assessed. Over a year, that can add up to a meaningful amount, and it's support you're only going to receive if you actually apply. Work and income won't automatically add it to your payment. You have to ask. Alongside this, there have also been updates to the income cutout points for the Community Services Card. If you're an NZ Super recipient, the annual before-tax income cutout is $39,796 if you're single and living alone, $37,372 if you're single and sharing accommodation, and $59,694 for a couple. If your income sits under those figures, you could be eligible for a Community Services Card, which reduces the cost of GP visits, prescriptions, and other health-related costs. This is one of those entitlements that people simply forget to check year on year, especially once their income situation changes. Stay with me, because change number 6 is one that involves an obligation you actually need to act on, not just information to file away. If you or your partner qualify for a pension from another country, this is what's called an overseas pension, and it can directly affect your NZ Super payments. This is one of the areas where mistakes happen most often, and unfortunately, they're mistakes that can end up costing pensioners money down the track. If you're entitled to an overseas pension and you don't declare it, and Work and Income discovers this later, whether through routine checks or otherwise, you could be facing a requirement to repay any NZ Super you were overpaid as a result. This isn't a small technicality. It's treated as a genuine reporting obligation, and it's your responsibility to disclose it. If you've spent significant time working or living overseas, particularly in countries like the United Kingdom, Australia, or anywhere else New Zealand holds a Social Security agreement with, it's worth checking directly with Work and Income's International Services team whether you have an overseas pension entitlement that needs to be declared. It's far better to sort this out proactively than to have it come back on you later. This connects to a broader point that applies to every single person watching this video right now, and it's change number 7. Your obligations don't stop once your NZ Super application is approved. There are ongoing reporting requirements you need to meet for as long as you're receiving payments. If your relationship status changes, whether that's a new partner moving in or a relationship ending, you need to tell work and income. If your address changes, you need to tell them. If your income situation changes in a way that might affect your tax code, you need to update that too. And if you're planning to go overseas, even for an extended holiday, there are rules around how that affects your ongoing payments. And you need to notify work and income before you leave, not after you get back. I know that might sound like a lot to keep track of, but here's the simple version. If anything about your personal circumstances changes, get into the habit of telling work and income as soon as it happens. It takes a few minutes and it protects you from the much bigger headache of an overpayment being discovered later, which then has to be repaid, sometimes with your future payments being reduced until the debt is cleared. Let's bring this all together because there's a lot of practical detail here, and I want to make sure you walk away from this video knowing exactly what to check for yourself. Number 1. Your NZ Super rate has increased from the 1st of April 2026. Compare your own situation, single living alone, single sharing, or as a couple, against the confirmed figures and make sure what's landing in your account matches what you're entitled to. Number 2, remember the payment timing. Your 7th of April payment will only be a partial increase, and because of Easter, that payment actually arrives early on the 3rd of April. Your first full new rate payment lands on the 21st of April. Number 3, and this is the big one, ignore the panic online about residency requirements suddenly jumping to 15 or 20 years in the middle of 2026. That is not what's happening. The real rule is a slow, staged increase based on your date of birth, and it's been in place since 2024. If you're already receiving NZ Super, none of this affects you. Number 4, check your tax code. If your income situation has changed at all over the last year, confirm with work and income or inland revenue that you're still on the correct code, so you're not left with a surprise bill or missing out on money you should be receiving each fortnight. Number 5, look into whether you might be entitled to the accommodation supplement or a community services card based on the updated thresholds. A lot of pensioners are entitled to this extra support and simply never check. Number 6, if you or your partner have an overseas pension entitlement, make sure it's properly declared. This protects you from a much bigger financial headache later on. And number 7, keep work and income updated on any changes to your circumstances, your relationship, your address, your income, or any travel plans as soon as they happen. You may want to check your eligibility after hearing all of this, particularly around the accommodation supplement and community services card, because these are the two entitlements pensioners most commonly miss out on simply because they didn't know to ask. If you found this update helpful, make sure you subscribe to New Zealand Pension Plan. I'm David, and my goal is to help you stay informed about NZD Super, WINZ, MSD, and every important government support update that could affect your finances. Thank you for watching, take care, and I'll see you in the next update.